Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at VivoPower.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and before we jump right into today's massive pivot, let's talk a bit about keeping your chart analysis sharp.
Oh, for sure.
Because, if you're looking at your portfolio right now and maybe struggling to read the price action clearly, you really should check out VIP Algos. The link is below in the description.
It's a genuinely helpful suite.
It really is. It's a TradingView indicator suite designed to give you visual buy and sell chart alerts. It's got trend direction tools, support and resistance zones, and clear areas to plan your take profits and stop losses.
But we do need to be incredibly clear here about what it is.
Exactly. This is strictly an educational chart analysis tool. It is absolutely not financial advice. It does not place trades for you, and it cannot guarantee profits.
Right, because trading always involves risk.
Always. So you have to manage your own risk and do your own research. And just a quick heads up, that link below is an affiliate link.
Which just means we may earn a commission if you use it at no extra cost to you.
Right. So let's unpack the reality of what just happened with our main topic today.
It's honestly a fundamental rewiring of a company's entire operational DNA. I mean, they just closed a $41 million acquisition of an operational data center up in Mo i Rana, Norway.
And it's not a small one either.
No, not at all. It's a 41.5 megawatt facility. We are not talking about some minor portfolio tweak here.
No, this is a move that completely flips their financial profile. They're going from bleeding capital to projecting immediate profitability.
And right as the global bottleneck for AI computing power reaches critical mass, too.
Exactly. The scale of that shift is what really demands attention. They are stepping in to supply the very thing restricting the entire artificial intelligence industry.
Which is energy-rich physical data centers.
Right. Right now, those facilities are effectively the most valuable real estate on Earth, simply because the software just cannot scale without them.
All right, let's move into the wealth-building context.
Well, when you're framing portfolio growth, the shift here is really about migrating out of speculative tech valuations, right?
Mm-hmm.
And anchoring into an EBITDA positive physical asset.
Which totally changes the narrative.
It does. It positions the stock as both a corporate turnaround and a sovereign AI infrastructure play. They hold a tangible cash-generating facility now, not just a concept.
I look at the broader AI market right now, and it kind of feels like watching a dozen high-speed rail companies trying to build the flashiest train.
Oh, that's a good way to put it.
Yeah, everyone is trying to guess whether OpenAI or Google is going to win the algorithm race.
Right, the gold rush.
Exactly. But it seems to me they are bypassing the train race entirely and just buying up the electricity grid that powers the tracks. They don't really care which software wins as long as the trains keep running.
Buying the grid is the perfect analogy, because if you want hard asset exposure to this shift, placing bets on software logic is incredibly high risk.
Yeah, software gets rewritten every day.
Exactly. Algorithms become obsolete in months, but foundationally, every single one of those platforms demands an astronomical amount of power,
Oh, and a highly controlled environment to house incredibly dense server racks.
Right. So owning the land, the power lines, and the cooling infrastructure provides this massive wealth-building foundation.
Because the demand for those physical resources is entirely software agnostic.
That gives us the bigger picture. Now let's look at the fundamentals.
Wait, $41 million for a single facility in Norway?
Yeah.
That just sounds like they're overpaying at the top of an AI bubble. I mean, how does the math actually work out to justify that kind of capital?
It sounds high, but the math actually points to a heavy intrinsic discount. Yeah, let's break down the valuation. They acquired a 41.5 megawatt facility for that $41 million. So that breaks down to roughly $1 million per megawatt.
Okay, $1 million per megawatt.
Right. Now, when you look at publicly listed peers operating AI data centers right now, the market is valuing them anywhere between $3 million and $8 million per megawatt.
Oh, wow. So they got it for a third of the low-end market rate?
Exactly. So strictly on an asset basis, securing this capacity at $1 million per megawatt suggests an enormous revaluation upside compared to the broader market.
And, it's not just the static value of the asset. The revenue transformation is pretty striking.
It's massive.
That $41 million purchase immediately bolts on approximately $31 million in annualized revenue.
Yeah.
And more importantly, it brings in $10 million in pro forma EBITDA.
Which is huge, considering they were previously reporting an adjusted EBITDA loss of about $8.2 million.
Right. This single acquisition reverses the current, dragging the entire group-level run rate into positive territory.
And beyond just flipping to profitability, there is a massive competitive moat built into this specific facility.
Like hydropower, right?
Yeah. They're gaining access to 100% renewable hydroelectric power, locked in at less than $0.035 per kilowatt hour.
Less than 4 cents. That's absurd.
Right. In the context of AI, where electricity is by far the heaviest operating expense, securing power at that rate is an incredible margin protector.
But we have to talk about the geography, too, because power is only half the equation here.
The cooling.
The other half is the thermal reality of running high-density chips. I mean, if you've ever felt your laptop heat up running a heavy program, multiply that by 1,000,000.
It's a literal fire hazard.
Exactly. High-performance AI server racks pull so much current that they can literally melt themselves without aggressive thermal management. Usually, data centers spend a fortune on massive HVAC air conditioning units.
Just to keep the room from catching fire.
Right. But by positioning in Mo i Rana, Norway, they are leveraging the naturally freezing Nordic climate.
Right.
They're literally pulling free ice-cold air from the environment to cool the servers.
Completely bypassing one of the most brutal operational costs of the industry.
Exactly.
And that natural advantage pairs perfectly with the governance side of their moat. The company carries a B Corporation certification.
Which a lot of people dismiss as just a trendy corporate badge.
They do, but it is a crucial fundamental tool for sovereign AI contracts. Like, imagine you're a sovereign nation, say a European government,
Okay.
and you need to build domestic AI infrastructure to process highly sensitive citizen data or national security algorithms.
You definitely cannot risk housing that on servers owned by a foreign tech conglomerate.
Right, where you don't control the governance. You need an independently audited, secure partner.
So the B Corp certification provides that verified framework.
Exactly. Transparency and strict governance. It signals to national governments that they are dealing with a neutral, highly regulated entity.
Not just a subsidiary of a massive data harvesting machine.
Right. And furthermore, the financial mechanics of this turnaround are incredibly clean.
How so?
Well, they funded the entire $41 million acquisition without tapping the public equity markets.
Wait, really? No immediate dilution?
Zero. Current shareholders faced zero immediate dilution to make this happen, which is basically an anomaly when a business attempts a pivot of this magnitude.
Plus, there's a serious potential reduction in overhead coming down the pipe. They are looking at a proposed Tembo business combination and a separate NASDAQ listing.
Right, the spinoff.
Yeah, and stripping that out could cut about $8 million in annual overhead out of the equation. That directly supercharges the free cash flow generated by the new Norway asset.
That gives us the business picture.
Yeah.
Now let's move to the catalyst timeline.
So the major milestone staring us down is June 30th, 2026. That's the target date for the finalization of the AI operator tenant leases for this Norway facility.
Which sounds like a long time.
It does. I mean, 2 years in the AI sector is a geological era. Entire generations of processing chips will launch and become obsolete by 2026.
Yeah, they really will.
So why on earth would an investor park capital now and wait 2 full years for a leasing catalyst to materialize?
Because the commercial groundwork is happening in real time right now. They aren't just sitting around waiting until 2026 to start making phone calls.
Oh, so they're shortlisting already.
The shortlisting of prospective tenants is highly active today. In fact, the initial firm proposals they received were broader and financially stronger than their own internal projections.
Oh, wow. So the demand is immediate.
Very immediate. The 2026 date is really just the final ink on the operational handover, not the start of the revenue negotiation.
I see.
And there are substantial near-term catalysts designed to bridge that waiting period, too. They have a massive 300-megawatt pipeline currently under development in Finland.
And aren't they waiting on a regulatory thing in Norway, too?
Yes. They are awaiting regulatory approval for a 40-megawatt expansion at the current Norway site.
Which would basically double their capacity.
Exactly. If that approval lands, it effectively doubles the facility they just bought, providing major speculative momentum well before the leases are fully finalized.
And hovering over all of these localized catalysts is the macro environment. We keep hearing about hyperscalers, the massive cloud providers like Amazon, AWS, Google, Microsoft.
They are under immense pressure right now.
Punishing pressure. They have to meet their ESG targets, environmental, social, and governance.
Right. They all made these huge public pledges to be carbon neutral.
But then the AI boom hit, and the power required to train these massive language models is shattering their energy budgets.
It's totally threatening their climate commitments.
So they are desperate for operational data centers running on pure, low-cost renewable energy.
A hydro-powered facility in Norway isn't just nice to have. It's a mandatory requirement for these hyperscalers to expand without violating their own pledges.
Catalysts tell us what could change the story. Now let's pivot to the chart.
Well, even without throwing traditional moving averages or volume profiles on the screen, the underlying physical reality is establishing a massive fundamental floor on the price structure.
The buyout offers.
Yes. Management recently revealed they received unsolicited offers to buy the Norway asset at a premium to the $41 million they just paid.
And they turned them down.
They turned those offers down. Rejecting an immediate premium is one of the strongest signals of intrinsic valuation.
It's like the housing market.
How so?
Well, if you buy a house in a neglected neighborhood and before the moving truck even arrives, property flippers are banging on your door offering you 20% more than you paid.
You instantly know you bought it for a steal.
Exactly. And two, you know the market is gentrifying way faster than anyone realized. If you know the neighborhood is taking off, you don't take the quick flip.
You hold the asset and let the structural value compound.
Right. By rejecting those buyouts, management is basically communicating to the market that the long-term cash flow potential from high-density AI leasing vastly outweighs a quick capital gain.
And that bidding friction implies a severely tightening supply market, too. When tenant demand forces unsolicited buyout offers, it telegraphs high future pricing power.
Yeah, that makes sense.
As the broader market begins to price in those inevitable higher utilization rates and lease premiums, it creates a very tangible structural floor beneath the equity. The downside becomes cushioned by the hard replacement cost of the asset itself.
So the chart gives us price structure, but what does market sentiment look like?
This creates a fascinating divergence, actually. If you run the recent news flow through quantitative algorithmic scoring, the automated systems scraping press releases,
Yeah.
they're categorizing the sentiment as strictly neutral.
Wait, neutral, they just executed a non-dilutive acquisition, flipped the business to profitability, secured cheap hydropower, and rejected premium buyout offers.
I know.
I struggle to understand how any algorithm processes that sequence of events and outputs neutral.
Well, automated systems are notoriously blind to qualitative nuance, especially when it comes to human capital and strategic hires. The qualitative sentiment across actual human analysts is overwhelmingly bullish.
Where's the disconnect coming from?
It largely stems from the appointment of Porter Harris to the advisory council.
Oh, I saw that. Porter Harris is a former lead battery engineer at SpaceX.
Yes.
Which immediately begs the question, why is an earthbound data center operation recruiting a literal rocket scientist?
It comes back to the physics of heat. Thermal management is the most restrictive bottleneck in AI computing right now.
Right, we talked about the cooling.
Yeah, the new generations of AI processors draw so much wattage that pushing traditional cold air over them is no longer sufficient. They require direct-to-chip liquid cooling or advanced phase change materials just to prevent thermal throttling.
And when you are engineering rockets at SpaceX, you are dealing with some of the most violent thermal dynamics and heat dissipation problems in physics.
Exactly.
You are trying to keep sensitive electronics from incinerating in a vacuum or during atmospheric reentry.
So by bringing a top SpaceX thermal engineer into the fold, the company is attacking the AI cooling bottleneck with aerospace-grade expertise.
Ah, I see.
A bot scraping a headline just reads, "New advisory council member appointed," and assigns it a neutral score, because that happens every day.
But a human analyst looks at the specific pedigree of that engineer, connects it to the industry's biggest physical limitation, and recognizes a massive strategic advantage.
It's a brilliant bridging of disciplines.
Yeah.
And matching that bullish sentiment is the insider flow.
The rejected buyout again.
Right. By turning down the premium buyout, the management team is firmly aligning themselves with the long-term shareholders. They are proving they have the conviction to build a multi-year wealth creation vehicle.
Rather than just cashing out for a short-term vanity win.
That sentiment picture is useful, but we still need to talk about the risks.
We absolutely have to ground this, because an operational pivot of this magnitude is riddled with execution hurdles. Repurposing a traditional data center to handle high-value AI compute is not as simple as unplugging old servers and plugging in new ones.
Oh, definitely not. The hardware requirements are incredibly specialized. Upgrading the Norway facility demands specific high-density knolling racks, upgraded power transformers, heavy structural
This
reinforcement.
to hold the immense weight of liquid-cooled server clusters.
Exactly. And securing that equipment means navigating a global supply chain that is currently stretched to its absolute limit.
Then you layer on the bureaucratic friction. They still need regulatory approval for their 40-megawatt expansion in Norway.
Yeah, that's still pending.
If the local municipality pushes back or environmental impact studies get delayed, that timeline slips. And if the timeline slips, tenant onboarding gets delayed, and that $10 million pro forma EBITDA projection starts to compress.
Right. It is a target, not a guarantee.
It-
But the towering risk, the true bear case that could actively destroy shareholder value, is capital constraint.
The future build-out.
Yes. We discussed their aggressive pipeline, targeting 358 megawatts of future capacity across Norway and Finland. Building out physical infrastructure on that scale requires hundreds of millions of dollars.
And if debt markets freeze or interest rates remain prohibitive, they won't be able to secure favorable project financing.
Which leads to the worst-case scenario.
Right. What happens if they can't get non-dilutive loans? They will be forced to turn to the equity markets. They will have to issue a massive mountain of new shares to fund the construction.
Heavily diluting the current shareholders.
Exactly. I mean, they managed the first $41 million acquisition masterfully without dilution, but replicating that for a massive 300-megawatt build-out is a monumental financial tightrope.
That is really the defining metric for the bear case. The upside is anchored by incredibly valuable physical infrastructure, but the downside is almost entirely dictated by their ability to finance future growth without printing new shares.
Because that would just erode the value of the existing equity.
So with everything on the table, what's the final verdict?
Well, looking comprehensively at the discounted asset valuation, the macro tailwinds from the hyperscalers, and weighing that against the heavy capital requirements for future expansion, we are looking at a bullish score of 8 out of 10.
And the investment horizon here is distinctly a multi-year hold, right?
Definitely a multi-year hold, just to allow the physical capacity and the leasing contracts to fully mature. To pull all these threads together, VivoPower has effectively rewired its corporate DNA.
They really have.
They have transitioned into an EBITDA-positive, sovereign AI infrastructure player. They acquired a strategic hydropowered data center in a naturally cooled climate at a highly disciplined 4 times EBITDA multiple.
And they managed it without diluting their investor base.
Right. The upside is fueled by an insatiable hyperscaler demand for ESG-compliant power and aerospace-level thermal engineering. But the vulnerability remains their ability to fund massive future expansions without resorting to dilutive equity raises.
And as a clear reminder to everyone tuning in, this entire breakdown is for educational purposes only. It is not financial advice, and we are not telling you to buy, sell, or hold any security.
You must weigh your own risk tolerance and do your own independent research before making any portfolio decisions.
Definitely.
If you want a cleaner, more visual way to analyze your own trading charts, you can check out VIP Algos. The link is below in the description. It is a TradingView indicator suite offering trend direction tools, support and resistance zones, and visual alerts to help plan your trades.
But remember, it's purely an educational tool, not financial advice.
Right. It doesn't guarantee profits, and trading inherently involves risk. That link is an affiliate link, so we may earn a commission at no extra cost to you.
And if this talk helped you map out the broader infrastructure landscape, please consider subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.
Before we wrap up, I just keep thinking about that rocket scientist working on data center cooling.
It's a crazy image, isn't it?
It really drives home the reality that the artificial intelligence revolution is no longer just a software game played in Silicon Valley office parks.
Not at all.
It is pushing the absolute boundaries of physical engineering, thermodynamics, and global energy grids. The infrastructure of tomorrow is being built with literal aerospace technology just to keep from melting down. Definitely something to keep an eye on.